All right, guys, we'll admit it. We messed up. Over the weekend, we heard rumblings that Calibre Mining and Equinox Gold didn't have the votes to proceed with their combination. We had intentions of covering it earlier this week, but well, it's been a busy week for M&A and major earnings, so we simply didn't get to it. And now the story has officially broke. As it turns out, our source was correct and they didn't have the votes. So things have been rejigged a bit. Let's dive in. Okay, let's start at the top. Back in February, as our longtime followers should know since we did a video on it, which you can find here, Calibre Mining had reached an agreement to be acquired by Equinox Gold. At the time we said, and I quote, Calibre shareholders would have been better off selling out their positions the day before the transaction was announced. That statement was based on a pretty simple premise. The transaction was announced on February 23rd. At the time, shareholders were to receive $3 worth of Equinox shares based on an exchange rate of 0.31 Equinox shares for each share of Calibre held. But on February 21st, Calibre closed the market at a price of $3.09 per share, meaning the transaction was quite literally at a discount to market. AKA, the terms for Calibre shareholders were garbage. And we weren't the only ones who thought that. As it turns out, the dive was just one of countless groups speaking out against the transaction. The pushback was instant. In a Reuters piece discussing the transaction, TD analysts were quoted as stating, "We would anticipate that some Calibre shareholders will be looking for a higher price, which includes a change of control premium. There is potential for a superior bid to emerge." RBC expected other suitors to come knocking due to the absolute lack of premium. And Van Eck, Calibre's largest shareholder with 8.69% ownership, even felt the need to publicly come out against the deal, stating that the transaction dilutes the quality and potential of Calibre. They later stated, "We are not supportive of this transaction. We don't see any synergies between any of the company's operations. Both operate in the Americas, but in vastly different locations," which removed any ambiguity in terms of their position on the matter. Smaller shareholders and market commentators alike also dunked on the deal. At Sultan Amriali, a shareholder of Fiore Gold before it was acquired by Calibre, stated that had he held this long, he'd be furious with the terms. Mike Szymanski says there's not enough upside to go around, while others felt that shareholders were left out entirely from the conversation. And then there was the CEO.ca board, and well, safe to say, the majority over there certainly weren't fans of the transaction, even in the slightest. Oh, and to add to things, Glass Lewis even recommended Calibre shareholders vote against the transaction. And when was the last time you heard of an independent proxy firm suggesting someone votes against a deal? They practically exist for the sole purpose of being a rubber stamp for boards of directors. And yet, for Calibre shareholders, the bad news has kept on coming. On April 1st, Equinox indicated that their Los Filos mine in Guerrero, Mexico would see their operations suspended indefinitely following the failure of the company to reach long-term land access agreements with one of the 3 local communities. The suspension has also delayed the proposed construction of a 10,000 ton per day carbon in leach processing plant that was set to increase gold recoveries. The mine in 2024 produced 170,000 ounces of gold at an AISC of $21.85 an ounce, accounting for 27% of production last year. Guidance was not provided for the mine for 2025, however, in a sign that Equinox was planning on the suspension. 2 weeks after that announcement, Calibre announced that the start of production at Valentine would be delayed, with ore processing now set to begin early in the third quarter. As recently as February of this year, Calibre had indicated that gold production would begin within the second quarter. Fast forward to this week, and well, Equinox and Calibre have basically said the quiet part out loud. They didn't have the votes. Terms on the transaction have been revised, however, only slightly, with Calibre shareholders now set to receive a 10% premium to the closing price of Calibre on February 21st, which was the last trading day before the announcement was made. Which isn't a whole lot, but I mean it is better. The revised terms call for Calibre shareholders to receive 0.35 of an Equinox share for each share of Calibre they hold, which as of February 21st would equate to $3.39 a share. As of the close of markets on April 23rd, the day before the revision was announced, it equates to about $3.24 a share, a 4% decline. despite the price of gold being up about $300 an ounce or 12% in the time since. In announcing the revised terms, Equinox indicated that about 70% of their shares had been voted in connection with the transaction, which had overwhelming approval for the deal. No such commentary was provided for Calibre, which means, well, shareholders hated it. Okay, so let's wrap it up. Are the revised terms enough to satisfy shareholders? Well, retail investors say no. But the assumption here is that major investors were involved in discussions to find a way to move the needle. It remains to be seen, however, whether the likes of Van Eck are now suddenly in favor of the deal. In any case, the vote has been delayed to May 1st, which means members of management set to get that golden parachute in the event that they are terminated post-transaction may have to wait a little longer to collect their check. All right, everybody, thanks for watching. We are in the thick of earnings season, so check out some of the content we have going on our channel right now. If there's stories you want us to cover, let me know in the comments section. Also, if you enjoyed our content, please give us a like, share our content. We appreciate all the engagement we get. All right, everybody, thanks for watching.